Good afternoon, everyone, and thank you for joining us in this loss mitigation update for 2021, actually the end of 2021. I want to introduce our guest speaker today, which is Ryan from FreddieMac. Ryan, would you please give your introductions and let our audience know, what your duties and responsibilities are at FreddieMac?
Absolutely, yeah, and nice to be here again with you and to have another chance to talk. So my name is Ryan McGinnis. I'm a director in the mortgage servicing policy division at FreddieMac, and my team is responsible for developing and implementing mortgage servicing policies with a focus on loss mitigation and foreclosure prevention. So we are responsible for putting together and then writing and putting out there different policies like forbearance and like the COVID-19 payment deferral and FlexMod and all the other options that are out there for Freddie Mac borrowers. And one other thing I'll mention is we do work closely with Fannie Mae and FHFA. So a lot of what I'll be talking about, I won't speak for Fannie, but a lot of what I will be talking about are what we consider to be aligned programs between the GSEs to help prevent foreclosure.
Awesome. So again, Ryan, thank you for joining us. My name is Fabian Casares. I am the Director of Realty Lending with the focus on down payment assistance and foreclosure prevention, homeowner retention. And here at NPHS, HUD-approved nonprofit, what we do is we provide information to consumers on the purchasing end and also on the foreclosure, possible foreclosure end with homeowner retention, again, foreclosure prevention through counseling, through education, financial literacy, credit counseling, so forth and so on. Our services offer an array of services that are all cost-free to the consumer. So with that, Ryan, I'm going to go ahead and get started on some questions that are lingering in the marketplace that many of our consumers, our audience, our industry professional partners really need to get the facts, because there's a lot of disinformation out there, a lot of confusion in the marketplace when it comes to forbearances and what we may consider now post-COVID, although we're still in the COVID era, but we see a lot of these programs that are now being utilized as a post-COVID process of programs. So I was looking at statistics this week, and I was looking at that we're about 1.1 million families in forbearances right now, and those every week are being reduced by either hundreds or thousands of families, homeowners that are now exiting because they've already either exercised their 12 months or 18 months of the forbearance program. Would you care to shed some light on that?
Sure. Yeah. I mean, and we certainly at Freddie Mac are seeing declines week over week in our forbearance populations, and we'll expect to continue to see that. I think one of the reasons for that is that the biggest groups entering into forbearance occurred right at the very beginning of when the pandemic began back in the March, April, and May and June of 2020. So with Freddie Mac and Fannie Mae policy and with a lot of others in the industry, we started off with forbearance up to 12 months, and then the CARES Act, of course, had forbearance up to 12 months. We then made for extensions, ultimately leading to what we have in place today, which allows for up to 18 months of forbearance, but also capped at delinquency of 18 months as well. So just to clarify that too, under GSE policy, the first 12 months of forbearance is irrespective of delinquency. So you could have been any level of delinquency and gone into those first 12 months of the forbearance under COVID-19 forbearance policy, consistent with what it said in the CARES Act. For extensions, so after that 12 months, that's when we have a delinquency cap at 18 months. So it's only for that up to 6 months of additional extensions. But what that means is that 18-month period, if you started right away, would have come up around September, and then the next big batch was October, and so on and so on. So we're starting to see borrowers who've actually used all 18 months of the forbearance and are now coming off of the forbearance. And so it's definitely something to keep an eye on. And what we do is that, first of all, there's always going to be outreach requirements for our servicers. So they have to start, if they haven't already, conducting outreach anytime a forbearance is within 30 days of an expiration. and to work out with the borrower what the next steps will be. And if there's more forbearance available to that borrower, next steps might be to extend the forbearance. But if not, you have to start looking at exit strategies, and so the exit strategies are going to depend on your circumstances. But we have a whole suite of options, and we can probably talk more about that as the conversation continues. But we want to see borrowers placed into the most appropriate solution for them, and we try to provide this wide array of options to hopefully make sure that happens. And now what we've been seeing is a lot of borrowers throughout the pandemic that have come out of the forbearance. We're going into either payment deferral to go back to the regular payment amount, or even just reinstating. So we've seen a lot of that so far. And I would expect that we'll start to see more loan modifications as well. Like the flex mod is what we offer. But there is a little bit of a lag between when you enter into the discussions for a loan modification and then the evaluation. We have a trial period plan that takes place, and then the loan gets modified permanently. So there is a period of time where you're not in forbearance, but you're not modified yet. And so I think probably some of the borrowers are now in that process where they're going through the trial period plans. But definitely something to keep an eye on, and hopefully we're going to be engaging, or our servicers are going to be engaging, and counselors are going to be engaging, and other trusted members of communities are engaging with borrowers and ensuring that they get the information they need and are put into the best program available for them.
Awesome. So let me ask you this. So when you're talking about the trial period, I'm assuming that's for your trial, your standard mod, the trial period. Correct. It's not when you're trying to engage, or is it when you're trying to engage in the flex mod or the payment deferment? That would be separate, or is that one the same?
So the payment deferral doesn't require any trial period. So with a payment deferral, you could kind of go straight from a forbearance. If it's done perfectly, you can go straight from the forbearance into the payment deferral as long as there's engagement. We do require that the servicers at least have a conversation with borrowers to get into payment deferral, but you could literally transition from the forbearance to the payment deferral immediately and go from having the forbearance protection straight to being current and reinstated under the payment deferral. With the flex modification actually does involve a trial period plan. It is now our standard mod. So we used to have a program we called standard modification, and we replaced that with the flex mod. So we do consider it to be kind of our standard modification, but it is official title is the flex mod. And that is an option for a borrower that can't afford their regular payment, but they do want to maintain home ownership, and they can afford a reduced payment. So the flex mod is able to generate a reduced payment for those borrowers if they qualify. But what we do, because it's for a borrower who has now what has become a permanent or very long-term hardship, and it hasn't completely resolved that hardship. Otherwise, payment deferral is probably the right choice for them. So because they haven't resolved the hardship, and with these later stage delinquent mortgages, we don't require documentation. So there's no proof of income or anything like that. So we put in place this what we call a trial period plan, which is you make 3 consecutive payments in 3 months in a row. At the projected modified payment amount, so the amount that you would ultimately be paying under the modification terms. And if you're able to do that, then you can sign the mod agreement, and it reinstates the loan at your new payment amount. But it's kind of a way to show the ability to pay without having to evaluate for ability to pay.
So let me ask you this, so that our audience can make sure they understand. So the payment deferment originally, or the program was first designed for a 12-month period, and then it went to an 18-month. So can the consumer now, when they go into the payment deferment, are they going to defer the total 18 months, or is that going to be a partial? Are they going to defer 12 months and then the other 6 months, that is the partial part of it? How is that repaid if it's not deferred?
No, it's a really good question. So yeah, to your point, when we first rolled out the COVID-19 payment deferral, it was intended to be for borrowers who were in those COVID-19 forbearances, and at that time, those only went to 12 months. So the program was designed to be for those borrowers. So it went to 12 months as well to match up with the delinquency threshold. As that threshold expanded and extended out to 18 months, we also did the same expansion of the COVID-19 payment deferral. So it now goes to 18 months of permitted deferred monthly payments. But we also made an adjustment when we extended the delinquency threshold to 18 months. Initially, we were saying you could only do one COVID-19 payment deferral. And we changed that because what we saw is some borrowers would come out and let's say for the example, I think that you provided where maybe you were 12 months delinquent, you came off the forbearance and got the COVID-19 payment deferral, but then you went back into a COVID-19 forbearance because maybe you weren't really ready yet, or maybe you had another hardship as a result of COVID, and then had another 6 months in forbearance. You can then defer that additional 6 months as well for an aggregate total of 18 months. So you wouldn't be able to do a COVID-19 payment deferral if the number of months that you are delinquent by, so the number of missed payments is going to exceed the aggregate total of 18 months under the COVID-19 hardship or hardships. Because the payment deferral has to reinstate the mortgage. So you can't do like a partial, you can't do, let's say you did 12 months before and now you're 8 months delinquent, and that would get you to 20 total months into the deferred balance. We wouldn't permit that as a payment deferral, at least not on a delegated basis for servicers. They'd have to ask for an exception because we'll only allow 18 months of missed payments to be put into that deferred balance, but it doesn't have to be all at once. It could be six, and then another 6 later. It could be any combination that gets you to 18, as long as it's all under the COVID-19 umbrella.
So what you're saying, and correct me if I'm wrong, that it's going to be one of two things. It's either going to be the 18 months straight or 12 months plus a re-entry of 2 or 3 months later for an aggregate of 18 months.
That's right.
Okay, great. Because we'll talk a little bit more about the entry percentages, because we are seeing those numbers actually that are at a high percentage based on the number of individuals that are still out there. But going back to the flex mod, so on the flex mod, you're looking that, or Freddie is looking at the flex mod as their standard modification now with the 3-month trial. But is that flex mod gonna allow, is it gonna dictate the 40 years, or is it 30 years, or what, or there's a combination of both?
So today, the flex mod is always going to be 40 years.
Right.
So it is going to be a 40-year term. We're trying to maximize payment relief with that. And so basically, like the full, what we call waterfall, is capitalize arrearages. So bring everything in to make it one UPB, all the delinquent amounts and other amounts that might be permitted to be capitalized into the balance. Then you extend the term to 40 years, then adjust the rate. And then if it applies, you might actually have another deferred balance. FlexMod also utilizes that deferral of some of the interest-bearing balance to create a separate non-interest-bearing balance that becomes kind of a balloon, for lack of a better term, that is due at the end of the mortgage. So the combination of those, what I'll call levers, different levers that you pull, is what generates the payment relief and tries to make the monthly payment obligation more affordable. And one of the other changes we made for COVID-19 is that we had historically not permitted for interest rate reduction if the loan to value ratio on the mortgage was less than 80%. So borrowers with a lot of equity, we wouldn't make that concession. And the reason for that is that traditionally loans with the lower LTVs, we were generating enough payment relief when we needed to do flex mods just by the term extension. And but when we did a lot of analysis on our COVID-19 forbearance populations, we saw that we were missing a pretty big portion. It was a sizable enough portion that we felt we needed to adjust, right? Where borrowers weren't going to be qualifying because of the not getting the interest rate relief in that lower LTV space. So we actually made a change to permit for the interest rate relief across the board, regardless of LTV, under our COVID-19 requirements. And that got our eligibility up close to 100% for borrowers where under the forbearance programs.
So one of the provisions under the flex mod in that 40-year term was up to a 20%. I've seen 20 to 30%. I'll just benchmark it at 20% payment reduction, because now you're extending the term, which gives a little bit of payment relief to the consumer. But that payment relief is, and correct me if I'm wrong, is more based on the extension of the term of the 40 years, as opposed to, as you just mentioned right now, the interest rate. Where many individuals, and also that some individuals are even thinking principal reduction. That's why their payment is dropping. Could you elaborate on that?
Yeah, so I mean, we won't do principal reduction at Freddie Mac. We do something similar where we take a portion of the interest bearing principal and we put that into that non-interest bearing balloon. So you still owe it, right? Like the non-interest bearing balance is still owed, but it's not part of the calculation that generates what you owe for your monthly payment. It's just a separate balance that kind of just sits there. So as an example of that, so just to explain that concept, let's say that your overall unpaid principal balance is $100,000 owed over 25 years, right? Well, if we were to take $20,000 off of that and put it into a non-interest bearing balance, now to calculate those same payments, you're doing it off of $80,000 instead of 100. So that's going to lower the payment amount. And now instead of 25 years, it's 40. That's going to lower the payment amount. And then if you cut the rate, that's going to lower the payment amount. So it's all these different levers that all work to try to lower your payment. To your point, if you have a shorter term, by far the most impactful of those levers is going to be the term extension. But for borrowers who have longer terms, maybe borrowers who had a previous modification, for example, might even have more than a 30-year term. Sometimes the other levers are going to be impactful as well. That's when you're going to see the deferred balances get used more. And again, as I mentioned, as long as your rate today is higher than our Freddie Mac modified rate, which is the 4-week primary mortgage market survey average. So should have checked before this call, but it's low. It's somewhere in the range of like 3.1%, and I need to check it, but it's still a pretty low rate.
Okay.
So anyway, the different levers are all what together generate the payment relief. And the way that the Flex Mod's designed is we do have a 20% target for 20% payment reduction target, but the target only applies if you haven't already achieved it once you do the kind of initial run through of the waterfall.
Mhm.
And so a lot of the time you go through our waterfall, you're actually getting more than 20%. But if you go through the whole thing and then you haven't, that's when you might start to try to do additional forbearance to get to that target amount.
So they can move around the moving parts to give the best workout solution. And that may be, as you mentioned, if the rate is more, if Freddie's rate is more than what the actual market rate is, and that can be adjusted. They can do that second deferred interest bearing or non-interest bearing second on the loan where you're not paying on that, but that will help reduce the monthly payment. So there's a variety of different options that the underwriter can utilize to see what's the best fit for that homeowner. Am I correct to say that?
Yes, that's right. Yeah.
Okay. Because that's what we're experiencing here at NPHS when the counselors are going through and they're submitting, and we're seeing the feedback from either the rejections and or the approvals. We see how our numbers are factored in. DTI, we standardly do it a certain way, but we're not structuring it to where we're adding in all those moving parts and making the adjustments or modifying accordingly to make that workout solution the most favorable workout solution for the consumer, the homeowner. So what you're telling me right now makes a lot of sense, because when we've been seeing these approvals and we're looking at numbers and we're looking at all the different approval factors on there, we're saying, okay, well, how did they determine this? How did they determine that? Because we're trying to figure out the math. But now it makes sense. And what you're saying that our benchmark is 20%, but in some cases it may be much more because we're aligning it with something different on the other moving parts of that particular package. Would it be safe to say that?
Right. Yeah. And actually, I'm going to try to say this. I mean, it's a very complicated thing, so it's hard to talk about a modification waterfall in a way that's simplistic or easy to have a conversation about. But the easiest way I would say it is that it is based off of certain loan to value ratio thresholds where the changes in the waterfall occur. So, for example, as I mentioned before, under normal circumstances, we don't provide rate relief if you have a loan to value ratio less than 80%. Right. We've changed that for COVID because COVID's just a whole different thing. But so 80% is kind of that first threshold. But then between 80% and 100%, you get the rate relief and you get the term extension. And then only if you haven't then achieved the 20% target, you'll start to apply that deferred balance forbearance. If you go over 100%, so now it's like what we would call an underwater mortgage, that's the most generous the terms could be,
Okay.
you actually are going to pull every lever right from the start until you get all the way down to the 100% loan to value ratio and the interest bearing balance. So you're going to already have applied the 40-year term, you're going to already have applied the rate relief, and you're going to already have applied some forbearance. And in some cases, those loans, if their like loan to value ratio is very high, can end up with a very significant amount of payment relief. And hopefully that's going to help them stay in the home. So, kind of to summarize and simplify a little bit, we tried to design the flex mod in such a way that it's more beneficial for people with higher loan to value ratios. So in other words, it's supposed to apply more favorably the worse your circumstances are, based on loan to value ratio as the barometer for what those circumstances are.
Sure. No, I get that, and that makes total sense. Because we are seeing a number of individuals that come to NPHS for counseling, or they, initial phone call, that I would say a high percentage have already had a modification in the past, were in default prior to COVID, and just took advantage of COVID, but now the circumstances are a little bit different now, because the regulations or the policies of post-COVID programs may not apply in totality to those individuals. I've been seeing personally here that we've been seeing individuals being denied any workout solution, and we see a higher percentage of those that have been denied are those homeowners that had a modification in the past. Mm-hmm. And it was just building up. And then now, because they breached that modification, although they got the forbearance, it's still a breach because they forfeited on their payment arrangement. They come back to us and say, well, no, we want to do this. We wanted the payment deferment. We want this. And as we convey to them, it's not up to tell you what you do and what you don't qualify. We'll package your package for you. We'll submit it up to your lender, but ultimately it's up to your lender to say yay or nay. And again, a high majority of those that are getting rejected for any workout solution right now are post-COVID recipients, or individuals who had a modification in the past. Speaking of pre-COVID, you and I had a conversation in the past that many of the programs that were designed for COVID may not apply to individuals that were already in default prior to COVID, which is right around January 28th of 2028. 2020. Has that changed? Is that changed since the last time we've spoken?
So yeah, there are what we would call, I guess, the COVID-19 programs. Like there's the COVID-19 payment deferral, and there's a COVID-19 version of FlexMod, which is the same. Well, let me back up. There is still a requirement on certain COVID-19 specific programs where the borrower would have had to have been current or only one payment past due, so current or a full month past due as of March 1st of 2020 to qualify under those requirements. So the payment deferral is probably the biggest one, because the regular guide payment deferral is only 2 months delinquent. So it's 1 or 2 missed payments. It was designed for a totally different reason. So we were able to leverage the concept, but it's not really, we completely changed what it does, right? The flex mod, you could still potentially be eligible, but what we've done is for the COVID-19 rules for the flex mod, your eligibility criteria is significantly easier if you were current as of that date. The concept behind that, it's similar to what we do with disaster events, is that if you wouldn't have become delinquent if not for these significant and impossible to foresee event, then you're more likely, if you say that your hardship is resolved, then you're more likely to be in a position to be able to be successful without us doing any additional evaluation. So disaster events have really proven that out. When we have disaster events, we'll waive a lot of the criteria for borrowers who only went delinquent because of the disaster, and they reperform tremendously well. But for a borrower who already had a hardship prior to COVID-19, we would treat them more like we would treat any borrower with any hardship, because there was already something going on. So we would want them to follow the regular criteria that's in place to try to identify the right solution for each borrower, and also to try to avoid setting a borrower up for a failure. right? So it doesn't mean they can't qualify for the flex mod. For the payment deferral, it might mean that, but for the flex mod, it doesn't mean they can't qualify. It just means that they might have to go through a somewhat more complete evaluation.
Going back to the modification real quick, just I don't believe I got the answer to that question. So the flex mod right now, which is FreddieMac is utilizing as their standard mod, we're saying the 40 years. Does Freddie offer a 30-year mod at any level now?
We do not today. We had in the past at times for certain mortgages, and I think it's something that we could discuss in the future. It's just I think during something like a pandemic is probably not the time where we would discuss that, mainly because you're trying to maximize the payment relief, really. I mean, and one of the things that actually, people in your position could really help borrowers with is understanding that they can control their own mortgage term as well. And if they're, if they are in a position where they have a legitimate hardship and they need the flex mod, but they probably could have done 30 years and it would have worked, but we didn't offer that. So that not through no fault of their own, they went out to 40 years. If they're savvy and they're educated on how to treat their own mortgage obligation, they could actually pay that mortgage off quicker than had they got the 30-year term, because what they could do is they're going to have a lower payment amount than they would have under the 30-year term, right? And if they want, they could pay the same amount they would have had under a 30-year term, but apply all the difference to principal purely, right?
Correct.
So and in doing that, you end up shaving off a lot of years. And I wouldn't advise someone to cheat the system and to do it that way, but if they didn't need the mod, but hey, if all we offer is a 40-year term and you don't want a 40-year term, it is in your control if you have the means, to be able to shorten that term on your own and even end up with better circumstances than you would have had you got the 30-year term.
Correct. What we recommend in our financial literacy is one of two things: is either to do the and more, an extra payment at the end of the year or two.
Yeah, right. Well, yeah, and that works too. Sure.
Correct. And or to ultimately refinance in a couple of years, their income being back to normal, their equity position being at par, and then based on that, they're able to again realign themselves to a 30-year or 50, whatever the case may be. But these are future options that we give them in the future, for the future with our financial literacy, to show them, hey, there are possibilities, there are ways that you can reduce that term. This is how, but again, that's based on your ability to do so. So great, that's that. So Brian, I'm going to talk about a couple of statistics here. Just want to kind of get your bit feedback, because these are the numbers that I look at, and I know that we were talking a little earlier, and we were talking that right now we're at an all-time low at 1.1 homeowners that are currently in forbearance, and I believe that Freddie and Fannie collectively was only roughly about 1% of that, I believe, based on your actual forbearances. But one of the things that kind of struck me is that right now we're at 15.3% of forbearances in the initial stages. So that's telling me that in the initial stages, these are individuals that are either reentries or just starting their forbearance term. Now, unless the date has changed, I believe that the forbearance term ends August of 22. So I'm assuming that keeping that particular date still accurate, that we're going to see individuals going into forbearance within the next year, because we're starting to see even at 15% that we have they're in the initial stages. 74.8 are in extensions, kind of going back to what you and I were talking about, that they initially did a 6 month, 12 months, either continued it for the total 18 months and or had a reentry. That tells me that there's still a number of families out there that are still having economic challenges. Regardless of what you hear in the media, that inflation is not a big threat. Unemployment is decreasing, so forth and so on. But there still are a number of families out there that are in distress, that are facing financial challenges. Even if they're back to work, they may not have the hours or the same job that they had in the past, accumulating the same income that they were pre-COVID. So that 74% of extensions were really caught my attention, and then you have 25% that are new entries, just starting the process. So these are not the re-entries; these are new applications that are actually coming in, and so it just strikes me as odd that, that we're seeing on one end that you're getting these hundreds or thousands of expired or forbearances that have already ran their term, and families are coming out of it now. And we're seeing that 1.1 million, but then we see, all these other entries going in. I don't really see the numbers. We always look at percentages. So I don't really see, what is 15%? Is that 15% of a million? Is that 15% of 4 million? When we were back at this time last year. But what is your take on the re-entries? What is your take on the new applications?
Sure.
How is Freddie handling this, or what is their interpretation of what they see when they see these kind of statistics?
Yeah, sure. So I think for the Freddie numbers on new entries, we're seeing pretty, I think, a lot lower numbers than that on our new entries. In terms of like the overall picture on forbearance, we had about 825,000 forbearances started at throughout the pandemic. So a lot, a lot of forbearances, and we are now right around 90, like under 95,000. So we're certainly at a much better place, and I'm not saying, by the way, that we ever had 825,000 in at one time, but that's how many were for Freddie Mac loans, or that was approximately the number of forbearance starts that we had. So, as you pointed out, Freddie and Fannie made it to 1% of our portfolios in forbearances recently, and those numbers continue to go down week over week. We talked a little bit about the MBA, report that comes out on Mondays, and I actually just happened to get one quick minute to glance at it before I started talking to you, and we went down 5 basis points just from last week to this week. The GSEs collectively, so we were down to 0.92%.
Wow.
Which is, it's still a large number. I mean, we're Freddie Mac and Fannie Mae. It's a lot of people, but I do think it's trending in the right direction, provided that those loans that are coming off the forbearances are going into good solutions. And we're just going to really need to keep our eye on that as we go forward, because you do see, still some people that are coming off and are just being reported as delinquent. And so, we'll have to get some more insight into what's going on with those loans, and hopefully they're engaged with the servicer and just working on getting into some type of a workout.
So I've got another question for you regarding refinance. So in our last conversation that we had talked about, in the event that the consumer makes 3 payments in a payment deferment and or a loan modification, and their other credit is up to par, that they have the ability to refinance. But there's going to be some homeowners out there that want to finance or refinance, shall I say, and don't have the equity to do so. But I do know that Freddie Mac does have offer the enhancement relief refinance. Could you talk a little bit about that, please?
I can talk a little bit about it, but that is kind of stretching my knowledge a little bit. So it just is a little background. So a relief refinance is for borrowers who need the relief, which kind of sort of fits under loss mitigation. But at Freddie Mac, because it's an origination, it's handled by another division. I still know a little bit about it, so yeah, I can talk about that. But that's going to be for borrowers with very high LTVs, and as you mentioned, and based on our last conversation, as we talked about, typically those refis are not going to be available if you've had a recent delinquency, and we've made some concessions on that for borrowers who became delinquent because of COVID-19, but have demonstrated some history of being able to make their payments. Like it could be under a trial period plan, and you're being evaluated for the refi, and you're on a trial period plan for the flex mod, and so to have that safety net of the flex mod, if you made all 3 trial period plan payments and you qualify for the refi, you can actually choose the refi instead. So that they've implemented this solution to try to be able to understand that some of these delinquencies caused by COVID are would have precluded people from being able to take advantage of this great rate environment, which is we're in right now, and we didn't want to do that. So they made concessions for the delinquencies. So if you've missed payments, but it's on a COVID-19 forbearance, and then you make a couple payments in a row, you might qualify. But for the relief refis, the LTV the loan to value ratio can be very high. I want to say it's 97%. I could be mistaken about that, but I think that's right.
So let me ask you right now on the foreclosure end, maybe you could touch on it, maybe not, but I'm going to ask. So from our understanding, based on the GSE or the HUD, VA, FHA, Ginnie Mae, USDA, that the protocol to actually to commence a foreclosure is going to be one of three. Well, three factors. Number one, that before a bank can or a lender can start a foreclosure process, that one, the consumer did not have a workout solution available to them. Secondly, that the property has been abandoned and it was confirmed through either a drive-by, an occupancy status by a broker, by internal staff, what have you. And third, that after 90 days of communicating and documenting, reach out to the homeowner, that there was no response or no communication, no interaction with them, and it's documented via emails, phone calls, letters sent to the home, and what have you. Is Freddie implementing that particular strategy before their lenders can start the notice of default and foreclosure process?
Yeah, I mean, I think you nailed the overview. The only other thing I think is included in that guidance is that if the borrower was in foreclosure prior to the pandemic, but anyway, yeah, those are the other reasons, the kind of carve outs. And that is CFPB regulations. So we absolutely fall under that, and it's mandated, it's law. So yeah, for Freddie Mac mortgages, our servicers can't initiate foreclosure unless they meet the requirements that you just described.
Yeah, because that's one of the things that we were looking at in on the notice of the default. Obviously, hard money, private money, portfolio loans, those follow some of the different guidelines. So they may be able to implement them, but as far as Freddie and Fannie and HUD's concerned, that's what our understanding is, and that's the information that we're conveying to consumers that are coming to us for general information. Obviously, one of them being, hey, if I don't get something, what's any workout solution? What plan B is available to me? And I explained to them, well, these are the three factors for the bank to start foreclosure in the event that you don't participate or cooperate with them. Another statistics that I found that they were stating that, and maybe you can allude on it or not, but they were stating that 20% of the individuals that were in forbearance were coming from areas of lower income and lower FICO. And they didn't state too much on the income limits or the AMIs and so forth, but they were saying out of that 20%, that they find that out of that 20%, because of the lack of interaction, information, working with nonprofits such as NPHS, that those are the recipients that have a higher probability of actually going to foreclosure, because they don't really know what their plan B is. They don't know what that next step is, especially if there's a language barrier, which always plays a role. But I do know that Freddie does have in their resource center a lot of information in multiple languages to give that information to consumers. Could you shed a little bit of light on that, please?
Yeah, absolutely. So, and we do, and that is always a challenge. It really is. And so, what we have tried to do is to arm people with as much information as possible. And so we have a tremendous amount of resources on our website, and then we also have in partnership with FHFA and Fannie Mae under an initiative that we worked on for a couple of years, and fortunately was completed before the pandemic. We have limited English proficiency resources on a shared website as well that provide things like examples of some of our letters that provide information of ours that are translated, and other educational materials. But then we also have an interactive resource on our website that's available in Spanish and English, and that helps to guide a borrower through the process based on their own circumstances. So they answer certain prompts, and it gives them information about what might be, the best available option for them. Now, the problem is that just having the resources isn't enough. People need to know about them. So we do, we have our servicers who we rely on to get information out there. And then we also rely on great partnerships, with organizations like yours to hopefully help as many people to get a hold of that information as possible. And, we really do want people to know help is there. but you need to work with somebody to make sure that you're getting the benefit of that assistance, because our options really do work for most borrowers. Especially if your delinquency was caused by the pandemic and you were current before that, the chances are you're going to qualify for something that's going to help you out.
And my last question to you leads right into that, about scams and entities that are offering modifications, offering payment deferment, offering workout solutions, offering different services to consumers at a cost. What does Freddie say about that?
Never, ever, ever pay somebody to help you get into a workout solution, because there are HUD-approved counselors. There are plenty of organizations out there, if you don't want to work with the servicer directly, that will help you, and they're not going to ask you for money. They're not going to ask you for money, and anybody that is probably someone you don't want to trust. And they're not going to be able to get you something that you can't get just based on your own interaction with somebody who should be trusted, or if you were to call your servicer directly.
Yeah, and I agree. And I wanted them to hear, the consumers, our audience, hear it from the source's mouth, because here at NPHS, through our counseling service, we provide all those services for free. And we get a number of individuals that come to us after they paid an attorney thousands of dollars, or they paid a modification company thousands of dollars. There was one company out there, I'm not going to say the name, but they're charging $500 to provide a forbearance package, which there's no such thing as a forbearance package in a sense, to consumers, but it's a $500 charge. And basically, it's just an intake sheet for you to send to the lender, but they're charging $500. And I'm getting calls from individuals that have already paid it or asked me, should they pay? And I said, look, why would you go pay them? We will do not only that, but much more for you for free. If not us, as you mentioned, there's a number of HUD-approved agencies, and I must stress HUD-approved agencies because they are credible. They have the know-how, they have the training, they have the funding that allows them to provide these services. And this is why there is no cost to the consumers. So with that said, Ryan, I want to thank you again for your time, your expertise, our relationship. That I'm very honored to have a person of your caliber to be on a Zoom, so that we can get out there and give the information to the consumers. We do this on a daily basis, but it's always nice to have the credibility from the sources such as yourself and FreddieMac to support what we're out there speaking and presenting. And when we can edify FreddieMac as a strategic partner and have you on these calls and the taping, so that we can put this on YouTube, we can put it on our websites, on Facebook, and just the information that the consumers can grasp, and it's a real-time conversation. I tell you, it's paramount in this industry because there's so much disinformation, misinformation, and a lot of scams going out there. And I think we're just starting to see that, because we're just starting to see many of the families coming out of forbearance and really having to start to exercise a workout solution. I don't anticipate, at least in my opinion, from what we're seeing here at NPHS and the market, that I don't really see that really happening to maybe the first part of the year, when many of these families really have to do something, that we're really going to start to see, some of the aftermath of the scams and all that other stuff, because now these families have to do something. So with that said, Ryan, on behalf of myself, Fabian Casares, NPHS, we thank you for doing this call with us, and we look forward to doing another call in the upcoming months to see what's changed, what's going on, and how can we partner and make our industry better and more informative. So with that, Ryan, thank you so very much. We truly appreciate it.
Thanks, Fabian. I really enjoyed my conversations with you, and it's my pleasure to be able to be here and talk with you.
Awesome. All righty. Thank you, Ryan.
Bye.
Goodbye.